If you are a foreign founder or investor planning to expand into India, you have probably asked yourself this: how will my company be taxed in India? It's one of the most important and often the most confusing questions global entrepreneurs face. And in this video, I am breaking down exactly how taxation works for foreign companies in India, how you can legally optimize your taxes, and the common mistakes you should avoid at all cost. So stay with me till the end because you will know exactly how to structure your business in India the smart way. Hi, I am Ayush Gupta, founder of JustStart, where we have helped hundreds of global entrepreneurs, founders in setting up and managing their business in India, from incorporation and compliance to taxation and repatriation. In today's video, we will simplify how India taxes foreign subsidiaries, branch offices as well as liaison offices, and how founders can plan better before they invest. Let's start with the basics. When a foreign company enters India, it can operate in one of three common ways. The first is subsidiary company, which is also called a private limited company. This is the most common route. The Indian entity is treated as a domestic company for tax purposes. Second is branch office, or it is also called project office. Here the entity remains a foreign company and it is taxed differently. And the third one is liaison office. This one cannot earn revenue. It is only for representation and coordination purpose. The taxation depends on which route you choose. So let's see how each one is taxed. For foreign subsidiaries registered in India as a private limited company, the standard corporate tax rate is 25% if the turnover is below rupees 400 crores. Plus surcharge and cess will be additional. For foreign companies operating as a branch or project office, the tax rate is higher, that is 40% plus surcharge and cess, because it is treated as a non-resident company or a non-resident office. Let's understand this by way of an example. Suppose if your US company opens a subsidiary in Bangalore, the Indian entity will pay 25% tax on profits earned in India. But if you operate only through a branch office, that profit may attract 40% tax. So most founders prefer a subsidiary structure for better tax efficiency and compliance flexibility. The DTAA ensures that your income is not taxed twice, once in India and again in your home country. For example, if your Indian subsidiary pays dividend to its parent company in Germany, Germany will give you credit for the tax already paid in India. But remember, to claim your DTA benefits, you must have a tax residency certificate from your home country, and second, proper disclosure in your Indian tax filings. This is a question every founder asks. How do I take my profits back home? And it is most important. Let us understand. There are typically three legal ways. First is dividend. Your Indian subsidiary can declare dividends which are taxed at the parent company's end, usually subject to 10% withholding tax and further subject to DTAA. The second is the royalty or technical fees. You can charge your Indian subsidiary for intellectual property or your technical know-how, taxed at around 10 to 15% withholding under the specified DTAA. And the third one is management fees. For cross-border management or consultancy services, withholding tax is around 10%, again depending on REIT benefits. The key is to structure these payments properly so that they are tax efficient as well as fully complied under the FEMA and transfer pricing rules. Now let us understand about transfer pricing. Transfer pricing is a major compliance area for foreign-owned companies in India. Let us understand in simple terms. If your Indian subsidiary transacts with your foreign parent or any group company, say through licensing, royalties or services, all transactions must happen at arm's length price, meaning as if they were between independent parties. You will also need to maintain documentation and possibly a transfer pricing study report, which is called TP report, every year. Non-compliance here can lead to heavy penalties. So this is the one area where foreign founders should not cut corners at all. Now let us talk about GST, goods and service tax, the indirect tax on goods and services in India. If your Indian company sells goods or services within India, GST applies at 18% in most cases. However, if you provide services to clients outside India and receive payment in foreign currency, that is treated as an export of services, which is zero rated under GST. This means you can claim input tax credit and don't pay GST on such exports. I have also seen many foreign founders make the same mistakes when they start out in India, such as setting up a branch office instead of a subsidiary and end up paying higher tax. Second is ignoring DTAA paperwork and paying double tax unnecessarily. The third is transferring profits or royalty without FEMA compliance, which can attract major penalties. Not maintaining transfer pricing documentation, especially in group transactions. Treating GST refunds casually and losing input tax credit benefits. The solution is get your structure and documentation right from day one. Indian tax regime might look complex from outside, but with the right structure, it's extremely founder friendly. Whether you are setting up a global capability center, an export-focused subsidiary, or a tech development arm, planning your taxes and repatriation strategy upfront will save you a lot of money and stress later. If you found this video helpful, make sure you hit the subscribe and don't forget to share it with your co-founders or investor group, because the right tax planning can make or break your Indian entry strategy. And if you're a foreign founder planning to incorporate in India, our team at JustStart can help you handle everything from company formation to tax compliance, repatriation setup, you name it, and we will do it. The link to book a free consultation is in the description below. Thanks for watching this video and see you in the next one.